A recent report from Realtor.com made headlines when it found the median age of all homebuyers was 59 and first-time homebuyers averaged 40. My next guest says those ugly headlines might make the housing market look worse than it is, and that there are some bright spots ahead in 2026. Jeff Taylor, Mphasis digital risk founder, joins me now. Jeff, that data came originally from the National Association of Realtors, and it was survey data, and it got a lot of attention, and people looked at it and sort of said, I'm never going to be able to avoid a house. Only people who are older can avoid a house. How did you interpret those numbers?
It's really great to see you, and thank you for having me. And so if you take a look at it, that survey, those numbers came from a survey that was 6,100 people, okay? So it's a very small subset. Number two, when you actually peel it back and look at what is the average median age for a home buyer, it's still 32 years old. It's been that way for over a decade. So when you really get to, and you brought it out, it really, really is there. So first-time home buyers, are in relatively good shape. And the reason why I say relatively good shape is right now, if I look at the overall market, first-time home buyers are still only 21% of the market, and that's a lowest number since 1981. So we definitely do need to see first-time home buyers coming back into the market in a more significant way. But we have a lot of optimism. I think they should.
Where does that optimism come from? What is going to change in this market that could make it more accessible to those first-time home buyers?
That's a great question. So as we look into 2026, right, we have a Fed who's going to most likely cut today another 25 basis points. And I think that we could see mortgage rates dip back into the high fives in 2026. So I think that's going to increase people wanting to come into the market, number one. Number two, if we look over national home prices in all states sort of came back around 3% last year for the first time, down. Now, that's nowhere near a market crash, right? A correction is usually 20%, but this 3% starts to show that it's becoming a little bit more affordable, and hopefully we see another 3 to 5% in 2026, so that can help affordability.
At the same time, when I talk to some folks within the fixed income market to which mortgage rates are pegged, they say even if the Fed starts to cut rates, we might not see, sort of those long rates come down that much, and therefore that we might not see mortgage rates come down that much. What do you expect?
That's exactly right. And if you look at the first two rate hike cuts that we had the previous year, actually mortgage rates went up. So when we see the cut today, I don't necessarily think that they're going to go up, but they could. But if I look into 2026, right, we're going to have a new Fed chair. And as we expect it to have the Fed rate actually cut a little bit more, as long as we don't have inflammatory concerns, then you could see mortgage rates come down. But if we're worried about inflation, then mortgage rates may come back up. So again, I don't think we're looking to see low fives in 2026, but the ability to get mortgage rates back into the high fives is something that we are optimistic on, for at least for a period of time in 2026.
And Jeff, I wanted to ask you about another stat, and this one came from Realtor.com, and it's about delistings, right? Somebody has a house on the market. It's not selling. They don't want to cut the price, and so they take it off the market. So we saw a 38% increase in those delistings year over year. What does that tell you about the market right now?
I think that ties back to the national decrease of home prices of about 3% over the course of the last year, is because people are saying, look, people for a long time have been able to essentially name their price, and people put their house in the market, people are hitting the full price or a lot of times bidding it up, and that has started to shift. It is becoming more of a buyer's market. It's not a huge buyer's market right now, but you're starting to see that transition, which the first indication of that usually is people delisting because they get frustrated they're not getting their price. They go back, they sit in the sidelines for 30 to 60 days. Then they maybe have a little bit more of a dose of reality, and they relist at a lower price versus accepting a lower price on their initial listing. The little bit of psychology, you have a little time to cool off and realize what the new landscape looks like, but that's what we're starting to see.
Jeff, we keep having a conversation about affordability. This is what everybody is talking about right now. And obviously housing is a big, big part of that. It's a big part of your monthly. It's the biggest part of your of what you're paying out monthly. What you're talking about is mostly some changes on the margins. Do you see anything from a policy perspective or anything bigger that is going to change the affordability, the housing affordability equation?
Look, we still have an issue, right? If you have the existing home price and new home price that are $415,000, that is essentially still too high from an affordability perspective. But if I go back to January, mortgage rates were averaging around 7.25. Today they're 6.25. So on a 30-year mortgage, that on a $400,000 house, that's a savings of $266 a month. Again, that's not a silver bullet. You could still say that's a little bit on the margin, but I think things here are going to take a little bit more time, right? And then we could see mortgage rates come back down to where it could actually help on the affordability aspect, as long with also, again, as supplies that cost to make these houses, right, as the tariffs fall off and what have you, and the cost of materials to build houses come back, especially in that sector. I think that will become a little bit more affordable going forward.
We shall see. Jeff, thank you so much. Appreciate it.
Thank you.